I'm going to create a bunch of fake Bitcoin wallets so I can bid up the value of my own so that it can go from 50 cents to $5 to $50. So it shows explosive growth. And the next person will buy it for 500 and then I'll just get out.
All right, this is episode 26 of Farm to Markets, and today we are talking about the slowdown in the ESG sector despite high demand, Netflix, why interest rates are still so low, and we're going to review some of our own NFT art at the end. According to an article in the Financial Planning magazine, the market for ESG, so environmental, social, and governance investments, had a record year in 2021 as ESG-focused exchange-traded funds attracted almost 130 billion in assets. Despite the demand for ESG investments, many green stocks had a bad year, with the S&P Global Clean Energy Index ending 2021 down 27%. And our own TAN solar ETF had to be replaced from our SSR strategy last year because of performance issues. Alex, why do you think ESG and green stocks are underperforming despite demand?
Well, I think you touched on it a little bit in the intro there. There is a difference between a green energy stock and an ESG stock or a mutual fund or an ETF. Typically, when we're talking about like green ETFs, we're talking about, like you mentioned, the solar installation and manufacture ETF. There's another one, FAN, just like TAN, but this one's for wind power. So ESG is a bigger banner that covers anything from like Catholic values ETFs, where they only invest in companies that meet certain standards of the Catholic Church. It could also mean things like investments that avoid firearm companies or defense contractors, or that avoid tobacco and alcohol companies. So ESG is this huge banner that isn't just interchangeable with green energy, at least not anymore. Last year, ESG investments did pretty well because there was a increased focus on, so like ethnic diversity in the workforce, women in leadership, things like that. And those investments did pretty well, but green energy got hammered. And that's part two of what I'll talk about now. So let's go back to right before the presidential election in 2020. For the few years preceding that, Russia and the Saudis were involved in an oil price war, and right around the time of the election, the Russians won. The Saudis cried uncle and decided to let oil prices go back up. And so 2021, you saw oil prices from the Saudis, from the Russians, basically all the producers increased in value or increased in price quite a bit. I think they're a little around double where they were. In the $40, $50 range, if I looked the right information up. So from an energy investor's standpoint, energy is energy. Wind energy, solar energy doesn't really directly compete with oil. It does compete with natural gas for power generation. But if you're an investor and you see energy in the form of oil going ballistic because all of a sudden the Saudis and the Russians have agreed to let the price go up, you might as well throw your money into the oil market rather than into the solar and wind market, which is over time doing well and will probably continue to do well, but last year it didn't do so well. So everybody sold out of their solar, their wind, their hydro, and bought oil and gas. Not very environmentally friendly, so not ESG at all, but they made a killing. Like the XOP oil and gas ETF was up like 50-something% for the year of 2021. So they did very well at the expense of the green energy sector that did very poorly. So if we're wondering why green stocks, green energy had a problem in 2021, it's because oil did very well and everybody would rather bet on the horse that's running really fast right now.
I think the reason why green stocks are slumping is that there's less incentive or perhaps even a disincentive to be a green energy consumer. Therefore, less people are willing to invest in these green energy companies. Right now, there's some green energy tax incentives and some subsidies that may be eliminated or reduced. There's Joe Biden's economic agenda, which is experiencing some friction in Congress. And the overall cost of green energy products is going up. Basically, if the government's going to pay you to be green, it's easy to do. But if they're not, then why would you do it? This is a perfect example of how choices are made at the margin. And economists use this term, meaning that decisions are typically made doing a little of something more or a little less of something, depending on the circumstances. Let's take water consumption, for example. Let's say that the average household in America consumes about 150 gallons of water per day. If the cost of water goes up, people don't just stop drinking water. Instead, they would use less water until that inconvenience of less water consumption equaled the inconvenience of paying higher prices for water. This is no different with green energy. If costs of using green energy go up, then the marginal utility of using that green energy goes down. And as a result, the price of those green energy stocks go down. So that's what I think is going on.
To Drew's point, I think that what's happened is a lot of these government incentives that once were available for green energy, they're starting to go away. If you think of it in terms of a brand spanking new restaurant, you open it up and you have your grand opening, and you had a big campaign where you put coupons for buy one, get one free for your restaurant. And the first day, 3 people came to your restaurant, but it turns out your food is pretty good. So they told their friends and buddies, and the next day there's 20 people that came in the restaurant. And then pretty soon there's like 500 people wanting to get in your restaurant. And then there's this huge line around the corner with their coupons. At some point, as the owner of the business, you don't really care about new customers. You're really frustrated that now you're having to give people really cheap food because you have all these free coupons for buy one, get one free. And what is happening in large markets like California is that it's now become so expensive to do solar energy because of all of the free coupons that they've given people for doing rooftop solar, that they're now taking those coupons away because the people who don't have solar are saying, why are we subsidizing solar? The benefit in the old days was a kilowatt of electricity was about 24 cents of benefit to a person who had solar capacity at their house. And on the 27th of January, if the State Assembly of California votes for this net energy metering value thing, could drop the value to an individual home to about 4 cents a kilowatt. At that point, it doesn't become cost effective for new people to be doing solar. Well, everybody loves to ride the gravy train. If somebody's going to pay you to have solar, it's a great deal. When you have to start paying your electric company $75 a month for the privilege of having your solar system hooked up to the grid, all of a sudden paying $900 a year doesn't sound that reasonable. And when you tell your friends and neighbors who haven't gotten solar yet, they're saying, I'm not so sure I want to do this. So you take away the incentives and people will stop buying it. And investors are pretty savvy about this kind of stuff. And they've just lost their enthusiasm for solar companies right now, or green companies for that matter.
Yeah, you guys pretty much said everything. Alex did make an important distinction that I don't think the article made, is that they did reference ESG investments, but what I think they were getting at is clean energy investments. So that was a good point. And to Drew's point, absolutely, Joe Manchin happened to the clean energy sector when he put the kibosh on Joe Biden's Build Back Better plan. And then, just like Joe says, that the California residents are no longer going to get the credit for dumping their extra electricity back into the grid. And on top of that, they got to pay like a $40 a month connection fee to hook up to that grid. So that makes it less appealing for them. And then I think the last thing that I don't know if anybody mentioned is that, between 2020 and 2021, the market priced in a lot of tremendous growth in the clean energy sector, and it basically just accelerated a lot of that performance into those last 2 years. And now we're kind of in the period where we're going to wait and start that. We want to see some of that performance pay off. We want to see windmills being created. We want to see electric cars. We want to see, solar energy, being put on all the rooftops in California. And if now that we've made all these promises and bought all the shares based on those promises, we want to start seeing this stuff actually happen. And so now we're kind of in that waiting period. And when you get, things like Joe Manchin, killing Joe Biden's bill, and California making decisions that are going to hurt solar energy, you're going to start seeing a sharper sell-off in these clean energy sectors because of that. All right, moving on. So is that Netflix, the American streaming and service production company that created the streaming industry and whose stock price has been up almost 103% since the pandemic, has seen a sharp decline since about December of last year. Is Netflix's share price decline just related to the recent sell-off in technology stocks, or do you think investors believe that Netflix has had its day as Apple, Disney, and Hulu compete for market share? Alex, what do you think?
Well, I think the recent sell-off is probably more of an explainer for Netflix's recent stock price performance. But in broader terms, I do think that Netflix has passed its explosive growth phase. There's increasing competition from other media companies that are finally, many of them at least, are finally relenting from their cable or theater first mentality and going straight to streaming or streaming almost immediately after they debut on cable or in theaters. And the barrier to entry is getting lower and lower. More and more people have high-speed internet than ever before every year. It doesn't take that much work to create a video streaming app these days, and most of the big entertainment and media companies are creating them. Warner Brothers has HBO Max, which is where they're parking everything Warner Brothers related. CBS and Viacom are doing everything under Paramount Plus. Disney now owns Hulu, as well as ESPN Plus and other streaming services. There's a bunch of others. So competition is getting fiercer, and that means Netflix is going to have to become better at creating its own quality content, or it's going to have to spend money to buy like the free agent shows, like your Seinfelds or your Friends or the Offices that oftentimes go up for bidding. Netflix just recently won the bid for Seinfeld, and I can't remember exactly what they paid, but they paid a lot of money for it. So increasingly, they're going to have to create their own good quality content to stand out from the crowd instead of being one of only 2 or 3 options. So I don't think we'll see a lot of explosive growth from Netflix, but they'll still probably be a very good quality company for a while at least. So don't see them tanking anytime soon.
When Netflix took The Office off of their platform, I almost ended my subscription right then and there, but I didn't. To answer the question, I think that it's just part of the greater tech sell-off. I think Netflix is just floating in the same harbor as all the other ships, and I think they're still a force to be reckoned with. Netflix, like Alex said, they're still putting out a lot of quality in-house content, and they're still successfully obtaining the rights to a lot of these other contents as well. As a consumer, I kind of like the fact that there's other companies out there competing with Netflix, because that might mean that I get more options for quality content at a cheaper price. Are they the next Blockbuster? No, I don't think so.
Whenever a company makes a decision to spend lots and lots of money to maintain market share or grow market share, investors start thinking, well, will this investment pay off? And Netflix has spent a ton of money on new content. It remains to be seen on whether that new content is going to actually turn into dollars to the bottom line. Mm-hmm. Secondly, is that we are a divided nation, and conservatives are every bit consumers of entertainment, just like progressives are. And if Netflix presents itself to the marketplace with a particular worldview and narrative with its content, and it turns off half the nation will be looking elsewhere for its new content. And when you're a company that in the old days, when Netflix was the only show in town for streaming products and services, they could be the bully on the block. But now they have to compete with a bunch of others. the margins are going to tighten up because they have to be all things to all people. And no matter what you do, you're going to tick somebody off, and that can affect your bottom line. And astute investors are considering all of these options before they buy Netflix.
Joe makes a good point, is that Netflix operating margin has increased from 4.3% in 2016 all the way up to 23%. And the biggest reason is that Netflix used to carry the cable shows. So you could essentially buy Netflix and watch a lot of the shows that were on cable without having to get cable. And back then it was like $5 or $7 a month to have to stream Netflix into your home and not have to purchase an expensive cable package. Now, a lot of those cable providers, those major networks that traditionally only had their product through cable, are making their own streaming services like Disney and Paramount and NBC and some of these other places. And now Netflix has to compete with those because all their content is now locked up on their streaming services, and Netflix has to go out and spend more money to create its own content. And so, yeah, so you're absolutely right. I mean, their margins are going to go way up. But I kind of agree with Drew, though, is that I think Netflix is kind of getting lumped into the same ball with the technology sector right now, and they still have a lot of things going for them. One is that Netflix, all they do is streaming. So when they compete with like Apple and Amazon have a vast array of other things that they're in. I mean, Apple makes iPhones and computers and iWatches. They dabbled in electric cars, and Amazon has like their cloud computing platform, and they got a lot of other stuff distracting them from the streaming service. Whereas Netflix is a little bit smaller, and all they do, and 100% of the time with all their company is focus on streaming. They have a couple avenues that they can exploit. One is that right now is that I think you can have up to 4 people logged into a Netflix account at a time. So if they really wanted to try and increase some of their user base, they could crack down on how many people could be logged into one account at any given time, so that people can't be sharing passwords as much as they currently are. And the second thing is that Netflix, unlike a lot of other network companies, is unencumbered by the type of content that they put on there. Is that they really have the rules around the content that Netflix produces is pretty lax relative to like CNBC or NBC or something like that. Whereas that writers and producers can be a little bit more edgy or whatever it is without the same kind of restrictions they would put on like network TV. So yeah, so I was right. So I kind of agree with kind of a fence sitter on this one, but yes, I think it's it's pulling back just because the technology sector as a whole is, but Netflix certainly has some obstacles they can overcome that they need to overcome, but they certainly have some avenues in which they can do it.
Are all you guys Netflix subscribers?
Yeah, we have it.
Yeah, but we recently got it. Like I said, we had our third baby, so that was kind of our treat to ourselves. And we were going to be up at midnight. We subscribed to Netflix just recently, so it's been fun for us. I mean, because we haven't been on there in forever. So
I don't have a subscription.
You did at one point, right?
I did. I did when there was plenty of content that I enjoyed. But recently, the content, your sister has it, and occasionally, she'll watch it, and then I'll look through what's available, and there's not a whole lot on there that I'm really interested in paying for.
So you are on Netflix.
What's that?
You are on Netflix. All right. It's no secret that inflation has been on the rise, but some investors remain puzzled as to why interest rates have not been moving in lockstep with inflation. Alex, can you shed some light on why interest rates are still so low despite high inflation numbers?
Well, the simplest answer is simply because the Federal Reserve hasn't raised them. But the more complicated answer is really ever since the financial crisis, we've been on this treadmill of trying to get the economy back to normal, even though, a lot of incredibly low interest rates and federal backstops for all kinds of debt and everything else has pretty much become normal. But what it's done is everybody is really addicted to basically free loans. When they can borrow for basically nothing and inflation is low at the same time, everybody can just keep things moving along with debt. Raising interest rates, the Federal Reserve has got this interesting problem. They have low unemployment, but interest rates are spiking, and they do have the dual mandate, which is low unemployment, but also low inflation. If you raise interest rates, it's going to make it more expensive for businesses to borrow. It's going to make it harder for them to continue their operations, more expensive for new businesses, fewer jobs, long story short. So that's going to potentially be a problem. And so the Federal Reserve is trying to balance between these two problems that it has. Do we want to destroy jobs to fight inflation, or do we let inflation eat away at people's earnings and savings? So they say they're going to raise them. Doing so is going to cause some issues. And typically in the past, they don't like to get involved in politics. And this is an election year, and raising rates in 2022 will not be good for Democrats since they are in the White House. They control the House and the Senate. I'm curious to see what kind of interest rate increases they do, but I don't expect them to do too many big ones. I would expect that they want to ease into it, and probably 2023 is when they start really tackling it if they are intent on doing it.
My short answer to that question is they don't move in lockstep. Interest rates and inflation are quite the opposite. We operate in a system where central banks set the short-term rates, and we actually see an inverse correlation between the rate of inflation and interest rates. Remember, short-term interest rates, they're artificial. They are manipulated by the Fed to attempt to heat up or cool down the rate of growth in our economy. I like to think of like a circus act. Those people who have the plates spinning on a stick, and they go a little bit to the right, and the plate goes to the left, so they adjust, and then the plate goes to the right. So they're constantly doing this balancing act. In general, as interest rates are reduced, more people are able to borrow more money. So the result is consumers have more money to spend. This causes the economy to grow and inflation increases like we're experiencing now. But the opposite holds true for rising interest rates. As interest rates go up, there's less liquidity in the economy, and consumers tend to save because returns from savings are higher. With less disposable income being spent, the economy slows and inflation decreases, and you have the same cycle all over again.
Alex said it very succinctly. The reason why short-term interest rates have not kept up with inflation is because we have a central banking system where the Fed sets short-term interest rates, and they keep them ridiculously low. The federal funds rate, which is the rate in which banks lend money back and forth to each other with their excess reserves overnight, is virtually 0%. Well, if the federal government's going to lend money to banks, and banks are going to lend it to you, and they're all competing against each other, and they're lending it back and forth at virtually 0%, there's absolutely no reason for them to raise interest rates on deposits. It doesn't make any sense for them to do so. Secondly, is that we're not only competing with banks for short-term interest rates, we're competing with governments all over the world, some of which are actually paying negative interest rates on some of their national debt. So there's just not a whole lot of incentives for people to raise interest rates at this particular time, as long as they can find cheap money. Given the option, I'd rather pay $1 for a hamburger than $2 for a hamburger. And to have the option of borrowing money at 0%, I'm going to do that as long as I can, even if it's bad for the economy. Finally, is that everybody who consumes in America's economy is a voter. And if they vote for continuing to have the party go on with low interest rates, ultimately, some politicians are going to run in front and say, well, I'll give you what you want. And I think that a lot of investors are believing that the Fed is not going to be as aggressive in handling interest rates as they say they are. That some people are holding out at the last minute. They're not going to raise interest rates as often as they say they're going to. So At the end of the day, I kind of would like to see a couple of years of higher interest rates. I like to lock in some high rates so that we can buy some fixed income like we did back in 2018, which was rather attractive rates. It's been almost 3.5 years since we've bought any CDs in our office. I'd like to start buying some again.
I too would selfishly like to see interest rates go up, just so the fact that we have some place to put short-term cash. And I actually have an answer to that question when people ask me about it. But I think Joe brought up a good point, is that it's not just the American economy that's going to be affected by raising interest rates. Is that a lot of the world is going to be affected by it too, specifically like Turkey and Venezuela, countries that have taken out US dollar denominated loans that are pegged to our interest rates. And they've essentially taken out, low interest rates loan to fund a lot of the things going on in their economy. And if we start raising those interest rates on them, it's going to get higher. It's going to get harder and harder for them to pay it back, especially in Turkey, is already experiencing just huge inflation right now, which is made their dollar close to worthless. And if we start raising our interest rates and making their loans more expensive to pay back, that's going to be really devastating for them. So whether it's our responsibility or not, that the Fed's also got to weigh the fact if they're going to be really aggressive with raising interest rates, not only going to affect the U.S., but it's going to have a lot of global ramifications as well. But to answer the question, I think everybody said it. The interest rates are low just mostly because the Federal Reserve has kept them low at this point. All right, so we'll move on to the last topic for our show today. With all the hype around non-fungible token art, or NFT art, Farm to Markets has decided to throw its hat in the ring and produce its own line of NFT art, with each person creating an original piece for our collection that we'll take a look at right now. Piece that we're going to look at here is from Alex Musso. And Alex, why don't you explain what's going on here?
So this is a photo that I took last February. Every year, my wife and I would go stay at the Isaac Walton Inn for a weekend and do some snowshoeing and some cross-country skiing. And we went snowshoeing out at the Gary Fire Lookout. The old location of it anyways is no longer there, but you can hike to the base. And so this is looking towards Glacier. And then I like the art style, the digital art style called pixel art, because it reminds me of when I was a kid and all the old video games and everything. And so I went to a pixel art generator and took that photo, ran it through the pixel art generator, touched up the colors and whatnot. And then there you have it. So that's looking towards the Glacier National Park from between Essex and West Glacier.
Very nice. All right, move on here. This is Drew's. And Drew, why don't you tell us, there's more than meets the eye here. Why don't you tell us what's going on?
There is. So this is a mosaic of Warren Buffett, created from thousands of pictures of me giving the thumbs up while eating lunch at my desk this morning. Same as Alex, I just ran it through a mosaic generator. And it cost, I think, $6 to download it in high definition. So you can't zoom in and see me, but you get the idea.
Nice. All right, so next one here, this is Joe's, but essentially Joe is too busy and important to create his own NFT art and decided to use company time and resources and had me do it this morning for him. So basically, he wanted some sort of farm scene. So I just kind of tried to decide what his homestead might look like after a freak winter storm. And basically, what I came up with is that after Joe's tractor is broken down because it can't handle the Montana cold, he quickly domesticates a bear so that he can go lead his goats and one chicken back to the farm and to safety.
Is he holding a gun?
No, that's a chicken.
Oh.
In the original picture that I stole this from, he is holding this is actually a Russian guy riding a Russian bear. But just for the sake of making this PG-13, I decided to, instead of a gun, Joe is holding a chicken. All right, so we'll move on to the last one. And this was mine. And you may recognize the face in the upper left-hand corner here. And essentially, viewers may not know, but we have a inter-office fantasy trading league where basically we just trade fantasy stocks. And Alex is currently the reigning champion. So in this picture, his trading glory is basically raining down on the coveted stock trading champion mug. So if you win our office league here, you get that cup, and that essentially adorns Alex's desk right now. I also threw a QR code on that, so if you hold your phone up to the screen, if you just go to the picture, if you just basically essentially go to the picture app on your phone and hold it over that QR code, it'll take you right to the Farm to Markets homepage on YouTube.
Nice.
So, all right. Well, that is it. Let me tell you what.
I value mine at $100 million. If anybody would like to buy it, go ahead and let me know. If you right click and save it, I will call the police on you, the cyber police.
Yeah, if we have the willpower, maybe we'll post these online, and you can buy one for 50 cents on some NFT art collection page.
Yeah.
Well, the copy
I'm going to create a bunch of fake Bitcoin wallets so I can bid up the value of my own, so that it can go from 50 cents to $5 to $50. So it shows explosive growth, and then the next person will buy it for 500, and then I'll just get out.
And now that we have you on tape saying that, might be an issue. So. All right. Well, that's it for episode 26 of Farm to Market. So we'll see you next week.